Thanks for tuning in to CAAMP TV, powered by the Mortgage Group. We're here live at CAAMP 2012 in the beautiful convention center. Here today we've got some Australians that have decided to join us. I've got Phil Naylor, who's the CEO of the Mortgage and Finance Association of Australia, and I've got Martin Ledham, who is the state manager with Australian Finance Group and also the president of the Mortgage and Finance Association of Australia. Welcome, gentlemen.
Thanks, Dan. Thank you.
Thanks for being with us, and it's a great day today and lots going on behind us today, so hopefully you guys will enjoy our little discussion we're having today. We're going to talk a little bit about Australia and the comparisons that they make with Canada and how they've really been able to amass 42% market share as brokers, was something that we aspire to. So why don't we just start off? Why don't you guys introduce yourselves? Phil, we'll start with you and maybe just give us a little synopsis of who you are and what you do.
Sure. Well, as you said, I'm the CEO of the Mortgage and Finance Association of Australia. We've got about 11,000 members, very similarly structured to CAAMP right across Australia. Australia's sort of like Canada. We're quite a big geographic nation, but most of the population are around the edges. You've got ice in the middle, we've got sand. But apart from that, we find that the culture is quite similar, the banking structure is quite similar. So we look very closely to what's going on in Canada to sort of benchmark ourselves. And I work very closely with your Jim Murphy, exchanging ideas. And that's why we're here, to sort of get an idea of what's going on in Canada this year and to get some benefit from what's happening here.
Of course. Martin, how about you?
Well, Dan, perhaps first I'll talk about my paid job.
Sounds good.
I work for a company called Australian Finance Group, which in our country we call it an aggregator, which effectively takes lots of brokers, mainly small independent brokers, brings them together into a cooperative and makes a very powerful group, for want of a better term. So I'm state manager in South Australia for Australian Finance Group. And my voluntary work then is as president of the MFAA, which I've been on the board now for 5 years. I've been involved with the association for 7 years, and I've just taken on that mantle as president. So that's my role. I'm here on a twofold basis from my perspective to learn and share information about our industry.
No, that's very interesting. And Martin, I know you gave me, some of you may know or not know, but you sent me a little synopsis of what the Australian marketplace looks like. And why don't you give us a little synopsis of that, because some people might not be as familiar as others.
Sure. The marketplace is probably very similar to Canada. We do have a good market share. The mortgage broker business has a 42% market share, which is probably edging towards $100 billion per annum. In settlements overall. Our brokers deal in lots of different areas, but it's the usual. It's the first home buyers, it's the investors, it's the refinances, and the market changes from time to time depending on what the current economic situation is. At this point in time, we're just starting to see the first home buyers coming back into the market. The investors have been a little bit quiet since the GFC, but again, they're starting to see value in the property market at this point in time. That there comes that tipping point where the yields start to get very attractive. So we're starting to see a little bit of movement now in some of our markets back into the positive, I suppose, after a couple of years of fairly flat.
I think that's a perfect segue into sort of my next question here is how is Australia doing currently, and how have they fared through the global financial crisis?
Well, I think probably out of all nations in the world, Australia and Canada are probably the two that really got through the GFC the best. We certainly suffered to some extent. There was a bit of a blip in our growth, but the fact that Australia's had a very strong mining industry, and that's really kept the country going, the economy going, has meant that we've sailed through it in not too bad fashion. And as we were saying before, we think we've come out of the other side, and we're now starting to see growth. Not miraculous growth, but nice positive growth, and that's really positive for consumers, because consumers now are starting to get a little bit more confident, and of course that helps our members.
Well, that's great.
If I can just add a little bit to that as well, Dan, from a broker industry perspective. I think the GFC, if we like to look from positives from the GFC, there probably weren't too many, but a couple of things it did for our industry. I think it gave it a good, healthy clean out. Right, we had an industry that was growing quite rapidly. People could make easy money, to be honest, and it's the same with any industry. When there's money to be made, people flock in from all areas. I think we had a good, healthy clean out, if you like, during the GFC. Those who were solid, remaining and committed to the business, a thing that helped them was the fact that they do have trial books. So as perhaps some of their business fell off, they could get through financially with their trial books, and it also accelerated the development of the industry in terms of quality and the use of online technologies. As the banks became a little bit more picky, I'd say, about the businesses they were taking from brokers. Online technology has worked really well for our business for productivity. So it probably accelerated what might have taken 5 to 7 years into a very short period of 2 years. So from a more professional angle, I think it actually did some good for our industry.
Well, that's fantastic. It's interesting because in Canada we saw a lot of that as well, and it was interesting. There's this persona that you could just become a broker and just show up and money just pours in, which we all know is not necessarily the case, but I think at some point in time it was a little easier than it may be today. So with regards to the real estate and mortgage market in Australia, I mean, where do you see it going over the next 12 months, 24 months, and so forth?
Well, as I was saying before, the market is starting to revive. Year-on-year growth is still fairly slow. It's about 4 or 5%, and it'll probably gradually increase. But we think with the offer that the value proposition that brokers are making to the community at the moment, we think there is an opportunity for that 42% market share to continue to increase, providing that brokers do demonstrate to consumers that they are trusted advisors, ethical and professional, and they're all the things that the association is trying to push and project to the community.
And I guess what challenges do you see coming down the pipe? Is there some big change in the industry that you may see coming forward?
I think from a broker's perspective, I don't think there's any particular major changes happening, but it's really just keeping up with small incremental changes. Now we're seeing a lot in the technology space and even the social media space. And I think that's where a lot of our longer term brokers can perhaps take a little step back and, there's a lot of, I don't want to be involved with Facebook or LinkedIn or Twitter, it's all beyond me. They're not difficult technologies, and the fact that we're seeing the banks starting to do more business in that area, and the next generation of borrowers maybe could care less about the interest rate they're getting on their loan compared to, can I actually do my banking on Facebook? And we start to see some of the banks now starting to operate in that area. So we have to be aware of that. I think we have to be aware of those technologies, and how as brokers can we fit in with those technologies as they develop. So rather than saying, I don't want to be involved, I think we have to know how it works and the potential effect on our business, because social media can be a fantastic way to get to a lot of people in a hurry. You can get a message out overnight, and we can use those technologies to our benefit.
You have to embrace where the clients are going. You can't try and force them into a square hole.
Go with them.
I think there used to be this argument that technology such as that is going to make it harder for the brokers. I think what we're seeing is brokers are seeing it as an opportunity rather than a threat. The good ones are really embracing it and using that to communicate with them and engage with their consumers.
That's interesting. That's interesting. I mean, there's always a lot of talk about social media. I mean, Twitter, it's sort of a new phenomenon, LinkedIn, Facebook, and there's constantly new ones evolving.
And it's all about engagement with your client. You don't necessarily sell stuff on social media, but what you do is you maintain that relationship with your client, and that is just as important as going and finding where your next loan is coming from, because it will come from those people. Rather than trying to get new people all the time, make sure you hang on to the ones that you've got.
Of course. Now, I know the two of you are here to take a look at the Canadian market, and I guess, what are your thoughts on the Canadian market, and do you look at other markets, whether it's the US, the UK?
Yeah, well, being a full-time employee of the association, I spent a lot of time looking at other countries and seeing how their markets are going, and really I've come to the conclusion that the only two really viable broker markets in the world, or the English-speaking world anyhow, are Canada and Australia. USA has been sort of decimated, the UK has been bashed around a fair bit, New Zealand to near Australia, they've had some issues too. So that the market that's most like us seems to be Canada. So that's why we're here, and that's why we're looking to see how we can benchmark.
It's definitely interesting. Now, is there stuff that you've learned from some of the other markets, or even from Canada so far?
Well, look, I think what we've learned from the other markets is what not to do, which is a handy thing to know. Look, we haven't been here long enough to be experts on the Canadian market, so it's probably a bit over the top to expect us to make too many comments about the Canadian market, but we do see a lot of similarities.
Yeah, and probably the number one topic for us to learn from you is, it seems as though brokers have gained almost mainstream acceptance in Australia. Is that fair to say? I
think that's fair to say. As you said before, that the broker channel has now got 42% market share. In fact, I was in Canada in 2003 to Symbol, as it was in those days, and then the market share in Australia was 25% and Canada was about the same. So we've moved on, and it's pretty hard to explain why. Martin and I have got some theories, but I think that the key thing is that an Australian broker has moved from what we call a transactional broker, who is just focused on the transaction, to one who's now becoming a trusted advisor, as building a long-term relationship with the client. So that the focus is really having that relationship on the basis that the transaction will follow, rather than going in and say the transaction is done, and then you move on and forget it and go to the next transaction. I'm not saying that's happening in Canada, but that's what we noticed in Australia.
So now the 42%, is that your ultimate peak? Have you been higher? Have you been lower? Do you see it scaling back?
I think that's probably the highest it's been. It's been gradually increasing over the last decade. It's slowed down a fraction during the GFC years. Maybe went back a little, but it's on the up and up now. And we measure it every 3 months. And it was 42, then it went to 40, then it's back to 41. So over a year, it'll probably average around 42. But we think the environment is such that because consumers are really see the value proposition with brokers for that 42 to increase, but it just won't increase because I'm saying it. Obviously, the broker's got to make it happen.
Well, and I guess the question then is what is the association doing, and what are the brokerages doing, or the banks to push the...
I think the key to me to get into the next level, if you like, how do you get from 40% to 50, 60%? I think we have the fundamentals there. We have the basics there to make it happen. For me, it's all about consumer awareness. We probably do have a reasonable consumer awareness at the moment, but we need more to get out there, I suppose, that our people are qualified. Particularly MFAA members will all be diploma qualified. The fact that they are licensed and adhere to strict codes of conduct, not just under the licensing regime, but also under the MFAA regime, and getting that message out there to more consumers that we are the first point of call, not the second point of call behind the bank. So you come to us first, not the banks first, and then mortgage brokers are seen as a second option. And I think we can do that. And again, without keep harping on about social media, isn't social media all about bragging? I think it is. We take the Facebook shot. We could do that right now. Click and we put it on Facebook. And here's me and Phil in Vancouver.
And 17 of your friends would like it.
And well, I haven't got that many friends, Dan. You have now. You can get that message out there in an instant. Then what a great opportunity to get our message out there that, as I was saying before, we are qualified. We do adhere to, strict codes of conduct and standards. And for that matter, brag about the successes with your clients. And we do. I have seen people now doing this on Facebook pages. We have that opportunity to get that out there, get that to a lot of people. And the fastest growing market of Facebook is the nanas. So we're not just talking about, Gen Y. We're talking about much older demographics. And we can get to these people and say, hey, this is fantastic. I can go online and find out information, through Facebook about, broken business or my home loan. I think we can, I don't want to keep harping on about social media because I'm no champion on it. But I think it is that opportunity to get that consumer awareness out there in a hurry. And I think we've got a great story to tell, so get out there and tell the story.
Well, what we do know is the vast majority of consumers in Australia do their research online, but they don't transact online, but they do their research. So from an association point of view, all our promotion is focused on digital online. So getting to consumers when they're looking around for research, they'll see MFAA approved broker. That's the call to come and look at our website, find a broker, find an MFAA member.
Of course. Now, is the onus falling on the brokerage, or is it the association that's really pushing the envelope to get the story out there, if you will?
Oh, I think it's both. I think individual brokers, as Martin was saying, the good ones are out there. They're on Facebook, they're Twittering and so forth, or they've got their own websites, or they're part of a group, and the group's doing a lot of advertising and promotion. A lot of referral. Most of the business in our industry comes from referrals. So MFAA is just part of that. We're not doing it all, and we're just doing the bit that we're pushing is the fact that these people are highly qualified, have a code of conduct, and high standards of education.
And do you see do you use the traditional medias, print, TV, radio, any of that to push the message out as well?
Yeah, we have. Look, we've experimented. We find the most effective way is online, because online you can track and you see how successful it is. Yeah. We can measure how many clicks go on our website and how many consumers look at our Find a Broker, whereas the other sort of advertising, press, radio is a bit of shotgun approach. How much of it works we don't know. But we're out there all the time, me as spokesperson for the organisation, in the media talking about issues so that consumers register the name MFAA. So when they're looking for a loan, hopefully subconsciously somewhere down they'll see, oh, I remember MFAA, that was a guy who was talking about mortgages on TV last week or whatever.
Interesting.
And again, there's plenty of information that MFAA puts out there now for our members. And I'm going to go back on the social media thing again, but you know, if you want to tweet something or Facebook something, yeah, we have that content. All you got to do is take it off from our site, send it out to your database, and it's about getting that double recognition, I suppose, that you know, if people can see our advertising banners. We don't do a lot of it, but on the newspapers or whatever, and then people see it in other forums, and my broker is also MFAA. People start to see the branding a lot more, put two and two together, and I think it's everybody's responsibility to build their industry. I don't think anybody can lump it on somebody else and say, I failed because you didn't do something.
So we have to work together as a
we work
as
together.
a group.
And I say the messages are the same. It's a great opportunity for us to all to work together, all to push the same message, and we all take responsibility in building our business.
I think the other point, we've talked about brokers to the community, but it's also in the other direction, brokers' relationship with lenders. Because this doesn't work unless the lenders support us as well. So the whole broker channel through the various groups such as ACCHA that Martin's with and others, really develop really good relations, strive to develop good relationships with the lenders so that we can get that straight through process from the product manufacturers through the credit advisors, the brokers, to the consumer.
But you've got to sell the story on both sides, as you say.
Absolutely.
I mean, the lenders are, I wouldn't say that they're more important than our clients, but I would say they're very, very close. It's a fine line to walk. Now, is there a certain demographic or group of individuals that you find are more likely to use a broker, or is it a little more widespread?
Look, I think it's fairly well spread. Though having said that, I think the low hanging fruit are probably the first home buyers because they haven't had exposure to dealing directly with. So I think brokers find that's a good market. Refinance is a good market as well. But in Australia, a lot of brokers have investor clients. So I'd say it goes across the board. Depends. Different brokers tend to specialise in different areas and different geographical areas. There could be different profiles.
I think in the early days of broking, I'm an ex-banker, 27 years banker before I got into the broking business, and we started to see a lot of business going to some of the non-bank lenders in those early days. We were talking the likes of Citibank, we had a group called Bank of Melbourne, Bank of New Zealand as it was in those days, and they flourished on doing debt reduction programs. So they were effectively taking people who've already got a mortgage, so mature people who've already got mortgages, and showing them how to pay off that debt. And I think that helped expand the demographic that we do deal with. So it's not just the younger generation who don't have any past history of dealing with banks. I think we have a good spread. And an interesting stat, Dan, is between 85 and 90% of all new-to-bank borrowers come through the broking channel. So that's why we have such a good relationship with our lenders. They can see where their new clients are coming from. So it's very important for them to be involved in the broker business.
So I guess, and in Australia, do all the banks deal with brokers?
In short, yes. There were a couple at the edge that didn't a while ago, but pretty well everyone is in the broker market.
Well, then maybe you can take me through that. If you were, I assume that you were probably in the business at the time when it wasn't all of them that were dealing with it. Like, what did that look like? How did you really, did it just sort of organically happen that they eventually said we have to do this, or was there discussion? Did you sell the story really well to them that they had to use brokers?
Do you want to handle that?
Yeah, well, look, I'll relate my own experience. I say I was in banking, 27-year banker, and I worked for a state-based bank, and we traditionally had up to 30% market share. We started to see our 1 percentage point at a time market share dropping, and the stats starting to go to the likes of banks that were non-retail banks that were operating through brokers. For a little while there, we thought we could take the brokers on and knock them out of the system, but it just wasn't happening. So initially, we reluctantly came into the game, I suppose, but recognising even at that point in time that maybe 10, 15, 20% of the business, if you're not operating with brokers, you're not operating in that business at all. So some of the in the early days, I'm talking here the mid to late 90s. The non-retail banks were starting to get market share, so the major banks, and let's face it, the analysts love market share when it comes to the value of the share price, all this sort of stuff. So we did start to see the likes of the major banks in Australia starting to come into the market. I think reluctantly at the time, why wouldn't you, as you're shaking up the norm for them. But recognising that it's market share, they're obviously not. If you're not playing in that space, you don't get an opportunity to look at it at all. So probably in the early 2000s, Phil, I think it'd probably be that we start to see the major banks come in, some quite belatedly, and almost having to buy into the market. So throwing out good specials there to get the broker business, be that through commissions or financial incentives to transfer loans over to those banks. So in the early 2000s, we started to see the major banks getting involved, and over the last 10 years, really, I think we've aligned more of that close relationship. So that reluctance has gone, and now they see this as a very viable channel for them. They have multiple channels to get business. 42% of it comes through the broker channel. So why wouldn't they be excited?
Yeah, that's definitely something to get excited about. And I guess, what do you do to enhance that partnership with your lenders? Is there regular dialogue? I don't know if the association's involved as well.
Well, yeah, at an association level, all the lenders belong to us. We don't represent them, but they belong to us. We have a lenders committee, and they discuss issues that concern them about the industry. So they have the opportunity of feeding into the association, into our strategy, and into the issues that we talk about. And of course, that external to the association, groups like Martin's, have a day-to-day discussion with lenders about issues. So there's, it's that thing about none of the parts of the chain stand alone. So it's really, that's probably one of the reasons for the success in Australia, is that everyone. I'm not saying it's all smooth sailing. There are arguments, but at the end of the day, the thing is to make sure the consumer gets the right product and the right advice, and you've got to have all parts of the chain working together.
That's for sure.
I think, as Phil mentioned there, it's imperative that the MFAA is involved with the lenders, and the lenders are members of the MFAA. It's a lot easier to have dialogue inside the tent rather than being outside the tent throwing rocks, because nobody really cares, and you have a less functional relationship if it is that way. So I think we have a very good relationship because they are inside the tent, and we talk, and there's dialogue regularly happening, and we see some great initiatives coming from the banks purely for the broker market. So I think it's working well.
So it's truly a partnership then at the end of the day.
Oh, look, I believe it is. I believe it is. If it's a partnership, it works.
Yeah.
If it's what have we got this afternoon, the grey cup or whatever, we've got two ends trying to smash the living daylights out of each other. Well, there's only going to be one winner.
Of course. Unfortunately, BC's not in it, so I can't support this year. But that's a whole other topic. I guess myself, I previously worked for Macquarie, and we made a joke earlier that I'm 1/16th Australian just by virtue of my previous employment. But now Macquarie came into Canada. What we usually associate Australia with is trailers. So, how much does that play into your business? And I guess, Martin, it's probably more closely related to your business, but what percentage is trailer in Australia?
Before the GFC, we were getting about a 25-cent trail on loans. Commissions were cut across the board during the GFC, and we've now probably averaged about 0.12 to 0.15 trail commissions. It varies. Some grow over years, but what that allows the broker to do is actually build a very viable business that does have value, and it can be sold later on for a value. But in the meantime, it's building up to pay your ongoing expenses. If you can get that covered by your trail book, that's fantastic. And it does allow to make this industry successful. It has to be financially viable. And I think the good upfronts that we get and the trail payments, all right, they're not as good as they used to be, and we are working harder for our dollar than we used to. But it is there. It is a financially viable business. So that helps with the success of as we go. So that's an important part of it. The trails are important, and if they were taken away, I think it would be a significant impediment to a lot of our broker business, our current broker businesses that really do rely on that.
Interesting. We talked a little bit about the technology that's out there and people doing their shopping online, and one of the big things in Canada is interest rates. I mean, they're so competitive. Is rate a huge thing in Australia as well? Is it the be-all, end-all?
It's probably the biggest factor, but it's not the all and end all. We do consumer research every 6 months, and it usually shows that consumers say, about 55% of consumers say rate is the most important thing when they're looking for a mortgage. So there are other factors that are out there. So rate probably is the initial attractor, but it's up to the broker then to sit down with the consumer and discuss what are the other parts of the features of the mortgage that they want. And at the end of the day, it mightn't be always the cheapest rate. It's the best or the most appropriate loan for them.
And so I guess the appropriate rate or appropriate loan, I mean, how close is good enough in the Australian market? Is it 0.5%, the whole percent?
To be in the ballpark, I think you need to be within 0.1, 0.2 of the best rates. If that, as Phil said, that will get the client in. You can talk to the client on that basis, but I think the great majority of our brokers sell on features and benefits. I've always said at the end of the day, a home loan is a home loan. It might be the cheapest rate today. Next week, somebody else has a cheaper rate or whatever. So it's more about the product and how the product fits. So I think our brokers are very good at doing that. They're very good at selling an appropriate product to the right person for the right purpose and for the future goals. And a lot of our regulation these days says you must take into account what may happen in the future. So you have to recommend a product that's going to be good, not just for today to buy this house or whatever, but is going to be appropriate for future
well,
years.
And forgive me if I'm mistaken, but is it true that you can't actually advertise that you have the best rate?
Absolutely. It's against the law in Australia to say that you have the best rate or you have the best anything, and you can't say you're independent and you can't say you're unbiased. So the reason for that is because the government says if you're earning a commission, you must be somehow a little bit biased, or the perception is you might be. I think the reality in most cases is that you're not, but this is all about perception. So our guys really have to be to sell the proposition. It's really, as Martin was saying, the valued relationship, becoming a good trusted advisor, and selling the features rather than just focusing on what is the best.
Totally, and I mean we see a lot of that in our marketplace, but it's interesting that would be illegal.
Yep.
So another thing that's really come up in Canada over I think since about 2008, we've had 4 sets of government intervention into our marketplace. How much does government regulation play into Australia, and has that made some changes for you?
Well, look, until about 5 years ago, the mortgage industry wasn't regulated much at all. The power to regulate credit was held by the state governments rather than the federal government, and there was regulation in Western Australia, licensing, and in New South Wales and Victoria and Australian Capital Territory. The other states had no mortgage, certainly no mortgage broker regulation at all. And what's happened since 2010, we have now a national act called the National Consumer Credit Protection Act, which regulates all credit, whether it be mortgage or any other sort of personal credit, which binds brokers but also binds lenders as well, so banks, credit unions, building society. Anyone who recommends or offers credit is covered by that. Now, so what that has done is to, I guess, push the marginal operators out, those who were potentially dodgy, and because they've had to abide by certain criteria. We think, from our membership point of view, what the regulation has done is basically enact what our regulations, internal regulations, were already. So anyone who was an MFAA member, in most cases, wouldn't have had any real problem in adapting to the new regulation. But it certainly gives the perception out there to the consumer that there is strong regulation, and if people do the wrong thing, or brokers or banks do the wrong thing, there is a government protection to make sure that there's recompense.
Certainly from a broker perspective, prior to the national regulation, MFAA was seen as the pseudo-regulator of the industry, I suppose. And with the national regulation coming in, it does allow us to take a little bit of a step back from that and become a true association body. Having said that, I think we still want to be very heavily involved to make sure that this regulation doesn't keep getting tampered with, minute after minute, because it has again had a little bit of an impediment on the broker business, and there's a bit more paperwork to do, and there is a process to follow, and it's made it harder to do that one appointment sale. A lot of times now you have to do the 2 appointments, get the information first up, get your particular documents in, then recommend a loan, get more documents signed away.
Yeah.
So that's our next area of productivity gain, I suppose. How do we get back to that one appointment sale? And again, you know, there are broker businesses such as the company that I work for, working on technology advances through iPads and apps and so forth to try and get back to that one appointment sale.
That's very interesting.
I guess our general proposition to government is that, you know, let the business do its own thing and don't intervene. But we did support the regulation because we thought it was essential to have a platform of consumer protection, which indirectly helps our members. But on the other side of the coin, there are some areas where we say to the government, you should intervene. And one of the areas where they're saying you should intervene is to overcome the problem at the moment where we think our major lenders, our major banks have got too much power in the market. The top 4 lenders have now got 85% of the market, and a lot of the second-tier lenders and the non-bank lenders, or monolines, as we call them in Canada, are really being squeezed out. And one of the reasons we're here is looking much more closely at the Canadian bond model, the CMHC, and we're trying to convince our government to do something like that in Australia in order to I guess, put a base and a protection for the securitisation market so that the smaller lenders can get some decent funding so they can compete more effectively as they were able to do before the GFC when they had a fairly strong share of the market.
And keep the top 4 honest.
Yep.
And competitive.
And so, I mean, and we emphasise to the top 4, this is not a bank bashing exercise. It's about making sure more competition makes everyone more efficient, and that's got to be good for the whole market. It's certainly good for the consumer.
And that's exactly what I say. It's, at the end of the day, it's all about the consumer, and the consumer deserves to have options. That's why you go to a mortgage broker, is to have options. And so we need that secondary market to be powerful and competitive.
Now, with your lobbying efforts to the government, are they successful? Do they listen? Is there open dialogue, or is it they kind of make their own decisions?
They're hearing, but I'm not sure whether they're listening. We've been pushing this barrow for about 3 or 4 years now, and there's a Senate committee inquiry, the report of which is to be released next week, or this week in fact, and we're hoping that committee inquiry will come out with a recommendation that our Treasury look really seriously at the aspects of the CMHC that could work in Australia. If we get that, we'll be pushing really hard to the government and the opposition parties to make that part of their platform for the next election.
That's fantastic. Well, hopefully they listen.
Hope so.
Well, I guess the last point that everyone will want to hear, and again, it's, you know, we're looking to you for some guidance on how we move the needle to 42% or to 50%. You know, what would be your one message that you could give to the Canadian brokers, lenders, marketplace that we could learn from the two of you?
Look, I think there's probably lots of messages, and we don't really know which works in the Canadians. But I guess from an association point of view, what we've tried to do is to increase standards and then promote that to the consumer. And if you get that right, at least you've got the best chance of getting consumers to come and look at our website and find a broker on our website. I mean, there's lots of other things that need to be done, and Martin might want to talk about those from an operational point of view.
Yeah, well, look, from my perspective, though, I think there are three key things in our market. One is it has to be financially viable. And I certainly think in Australia we have that with upfronts and trails, which we work for, by the way.
And for all parties as well.
From all parties. We need willing participants. Now, I think we have good relationships with our lenders. They want our business, so you know they're actively trying to come and find it, so they're not acting against us. And finally, you need that consumer awareness. So if you can get all those things working and working well, then I think you have every opportunity of continuing to build that business.
If I can reiterate, I mean, the number one thing I hear from you over and over and over again is, you know, besides company lines, we need to look at improving awareness.
Absolutely.
Whether it's with our lenders, our government, or our consumers at the end of the day.
Absolutely.
Well, I really thank you, gentlemen, for joining us today, and I thank everyone for tuning in to CAAMP TV. And we will be back at 1:30 where we have our monoline lender panel, and hope you guys enjoy the show and enjoy Canada while you're here.
Yeah, thanks, Dave. Thank you very much.
Thank you.
What should I do with the money I earn over my summer job? Or how do I start saving for my first car? My first house? In every stage of our lives, we have different demanding financial needs, and staying on top of these needs is overwhelming, but it is definitely possible. The key? Financial literacy. Being financially literate means being able to make sound decisions based on financial knowledge. It means being able to manage the way you spend your money, and it all starts with an understanding of how finances directly impact our lives. As a university student, some things that keep me on my toes are tuition, textbook money, student fees, monthly rental, groceries, and the list goes on. So how do I manage my finances? Well, first, I keep a budget composed of discretionary and non-discretionary expenses. The non-discretionary expenses are the ones that I'm obliged to pay no matter what, like tuition. For me, with limited source of income, I limit my discretionary spendings to $20 a week, which I keep track of using an Excel spreadsheet and keeping all of my receipts and recording all of this information on my spreadsheet on a daily basis. Second, I save. Any extra money that I earn gets put aside in a tax-free savings account where I'm currently investing in mutual funds. This is an excellent way for me to earn interest on my savings tax-free. So what are some tips for managing your own financial matters? Well, that really depends on your life stage and your financial goals. So start simple and set yourself some goals. What do you want to be able to accomplish in 1 year, 5 years, 10 years? Plan ahead for the future and be specific with your goals. For example, make it a goal to contribute a certain percentage of your monthly income to a savings account. Then commit. Assess whether you have the funds to start saving. If you have any debt, pay that back first. To manage debt levels, keep a budget and set yourself a credit limit. Always try to ensure that income is greater than spending to avoid any unnecessary debt. If you're taking out a loan, paying back that loan and any associated interest payments become part of your non-discretionary spending. Pay it back first. High interest rates can become a very dangerous game. Now, if you have some extra money left over, you may want to start saving. But before you go ahead and do so, assess the level of risk you're willing to assume. If you're a complete risk-averse investor, stick with guaranteed investment certificates or government T-bills. While they provide lower returns on your investment, they are the safest bet. Also, stay informed with the macroeconomy to see whether or not this is a good time to invest in some other securities. Or, for example, what's the employment outlook in the industry right now? Is it in a growth stage, decline stage? Keep in mind that investments will tie up your cash flow, so plan to stay flexible in case of any emergencies. And finally, never hesitate to contact your financial advisor. Work together to formulate a plan to start meeting your goals. Remember, it's never too late to start managing your finances. My name is Marco, and I am a third-year student in the Accounting and Financial Management program at the University of Waterloo. I believe I deserve to win this award because my education is dedicated to financial literacy. But aside from this, I am also a very deserving candidate because I am passionate for finance. In my spare time, I keep up to date with financial information through my subscriptions of Canadian Business and Money Sense magazines. Currently, I am also a teaching assistant for a course called Introduction to Business in North America, where one of the modules focuses on financial management of a company. I am passionate for sharing my knowledge and understand the importance and value of financial literacy. For this reason, I believe my values align closely with those of the CAAMP Foundation. In the future, I hope to be able to continue sharing my financial knowledge with other people, and certainly this award would be a very helpful kickstart to a great future.
Bob and Ted bought their houses at the same time, with the same features, and paid the same price. Ted used the services of an accredited mortgage professional. Bob didn't. When financing a home, an accredited mortgage professional, or AMP, can help. An AMP will explain all your mortgage options, provide expert advice, and provide you with mortgage peace of mind. Looking for a mortgage? An AMP will find the best solution for you. When you think mortgage, think AMP.
The Canadian Association of Accredited Mortgage Professionals. The foundation of Canada's mortgage industry, empowering Canadians to become responsible homeowners. In 1994, Canadian mortgage professionals from across the country came together with a singular vision to build a professional association that spoke with one voice and was reflective of all sectors of the Canadian mortgage industry. Today, CAAMP is that voice. From coast to coast to coast, 12,000 CAAMP members empower Canada's growth. With $1 trillion in mortgages outstanding, we are a pillar of the Canadian economy. CAAMP is recognized both at home and abroad as the authoritative source for the Canadian mortgage marketplace. CAAMP continues to promote positive change in our industry. Our members help Canadians make their dreams of responsible homeownership come true every day. Owning a home is an important accomplishment, but it means so much more than bricks and mortar. If you ask most people what their home means to them, they'll talk about family, watching their children grow, celebrations with friends and neighbors, birthday parties in the backyard, special memories, and a feeling of belonging to a community. That's what homeownership means to most of us, and that's what we are helping to provide Canadians. When the time comes to finance a home, consumers look to CAAMP members and the Accredited Mortgage Professional designation. The AMP designation signals to the buyer that their mortgage professional is well-trained, well-informed, and committed to upholding the highest ethical standards in our industry. In partnership with Credit Canada, CAAMP will empower Canadians to make wise financial choices with the creation of a financial literacy project for Canadian homebuyers. Financial literacy is key to personal financial success. It underpins a healthy economy and a stable mortgage market. As CAAMP grows and evolves in the years to come, we look forward to meeting the challenges of our ever-changing industry. Through education and advocacy, we will continue to enhance our leadership role as the voice of our industry, and we welcome every opportunity to assist Canadians with making the most informed mortgage decisions. CAAMP members are committed to raising the bar on professionalism. As a CAAMP member, you play a fundamental role in building the strength of our industry and our country, empowering Canadians through education and advocacy. We are the Canadian Association of Accredited Mortgage Professionals.
The Accredited Mortgage Professional is Canada's designation for mortgage professionals. Being an AMP enhances your reputation as a mortgage professional and demonstrates your commitment to the highest standard of performance. The AMP provides added value to borrowers and mortgage industry professionals and can help grow your business. An increasing number of Canadian mortgage consumers are becoming more aware of the AMP designation and are seeking the services and advice of an accredited mortgage professional. This past year marked the reinvention of the AMP logo and tagline, "Working for You," which places more of a consumer focus on the brand and better depicts the role of an AMP. CAAMP is committed to supporting and promoting the designation and invests over 90% of AMP dues back into its promotion. Raising public awareness of industry standards and enhanced professionalism bring value to the designation, to the association, and to the industry as a whole. To learn more, contact amp@caamp.org. This year, Canada Guarantee experienced significant growth as demonstrated by the successful relationships established with Scotiabank, RBC Royal Bank, and ING Direct. Canada Guarantee continues to expand its national presence with account executives and regional underwriters, offering dedicated support and local market expertise. In addition to ensuring every call to the National Underwriting Centre is answered directly by an underwriter, Canada Guarantee offers extended business coverage to provide increased support and improved turnaround time for applications submitted after standard business hours. Whether in the office or on the road, Canada Guarantee app offers mobile access to valuable tools and essential product information conveniently available through your iPhone, BlackBerry, or Android device. As the only 100% Canadian-owned private mortgage insurer, Canada Guarantee is committed to elevating the home buying experience for lenders, mortgage professionals, and consumers alike. Discover how value-added solutions, comprehensive training, and the dedicated support from Canada Guarantee's experienced team can help you succeed. With unstoppable growth since inception, Dominion Lending Centers has grown to a network of members that span from coast to coast. With hundreds of street front office locations positioned across our beautiful country, we have become known as Canada's national mortgage company. Inspired by opportunity, driven by leadership, there is only one Dominion Lending Centers. People join Dominion Lending Centers for all sorts of reasons: the compensation, the technology, the training, the vision, the brand, and more. And with new exclusive programs such as Enriched Academy, Plan B Mortgage Services, unsecured Visa cards, and the Dominion Charity, we are innovating every day. Make your career your success story. Today is really when your new career begins. Contact us to learn more. We look forward to serving you. Genworth Canada welcomes you to the 2012 Mortgage Forum. As Canada's largest private mortgage insurer, Genworth Canada is committed to making homeownership more affordable and accessible for Canadians. Working together with brokers and lenders across the country, the company has helped more than 1 million families achieve their homeownership dreams. Genworth Canada is also committed to helping homeowners stay in their homes during difficult financial times. Their homeowner assistance program is recognized as the best in its class, having helped more than 19,000 families avoid foreclosure through innovative workout solutions. Through homeownership and financial literacy education and active support of many local and national charitable causes, they continue to be a significant contributor to the health and prosperity of communities across the country. To learn more and to have a tour of their new website, visit the Genworth Canada booth. Be sure to enter their annual iPad draws. The success of any mortgage professional lies in their knowledge, skills, and competency. As the foremost provider of mortgage-related instruction, CAAMP plays an integral role in providing timely and relevant training and education opportunities. CAAMP's courses are all accessible through Mortgage Campus, the convenient and comprehensive resource for quality, cost-effective professional development courses. Designed to help members increase efficiency and productivity to stay competitive, Mortgage Campus courses include provincial licensing and relicensing, AMP pre-accreditation, practical brokering, and compulsory and professional development continuing education courses. Mortgage Campus is an essential mortgage education resource designed to ensure mortgage professionals have the knowledge and capabilities necessary to understand current business trends and changing industry regulations, adapt to an ever-changing marketplace, and maintain a competitive edge through Mortgage Campus. Course content is updated regularly to reflect changes in the industry, so visit the site often to stay up to date. Mortgage Campus, setting the standard of mortgage industry excellence. Visit us at www.mortgagecampus.org. Scotia Mortgage Authority provides you with prompt, personal service combined with access to a wide range of innovative products. We are solidly committed to the mortgage broker business, and that dedication to our broker's success manifests itself in faster approval and adjudication times, and service that will deliver results to your clients. Scotia Mortgage Authority believes that you should be rewarded for your business. As one of our top brokers, you'll benefit from the personal service of a broker relationship manager, a one-stop relationship that will save you time and effort. On top of outstanding service, you will have the full suite of Scotiabank's mortgage products at your disposal, including the popular Scotia Total Equity Plan. You're among those at the peak of a competitive field, and you've worked hard to get there. By choosing Scotia Mortgage Authority, you'll be partnering with an organization that will work equally hard to ensure your continued success. Join us. Succeed with authority. Street Capital believes mortgage professionals are an integral part of the mortgage process. Street Capital is 100% committed to securing long-lasting, valuable relationships with mortgage brokers. Street Capital's status-level brokers enjoy a service-level commitment that includes dedicated sales support, personalized underwriting, and funding services, as well as access to discounted pricing, street rewards, and street pricing credits. Additionally, Street's competitive compensation plans and dedicated underwriting provide support to brokers to grow their businesses. With 3 great compensation models for status brokers to choose from, Street is providing opportunities to earn income now and later. Choose from traditional Street, loyalty upfront, or loyalty trailer programs. With the launch of the Street Options program, an uninsured program for borrowers who don't meet traditional lending guidelines, Street Capital is now providing brokers with a more comprehensive product suite. Street Capital, broker focused, broker loyal. Verico is Canada's #1 mortgage broker network with over 190 offices and 2,300 plus mortgage agents who originate over $12 billion in annual loan volume. Our brokers collectively originate approximately over 45,000 plus mortgage transactions per year. Verico is comprised of the top professional and influential mortgage companies and originators in the country. The Verico Mortgage Broker Network prides itself on our core pillars of excellence, professionalism, and ethical standards, and as a result, we have earned a reputation that is coveted in the industry. Find out why the most respected brokers and influential mortgage companies in this industry are members of the Verico Network. Talk to us. You'll be impressed.
Thank you everyone for tuning in here to CAAMP TV, powered by TMG, the mortgage group. We're really thrilled to have another panel here at the CAAMP 2012 Mortgage Forum. This time we'll be talking with some of our monoline partners, and they'll be sharing with us a little bit about the industry, but also why monolines matter in today's marketplace. So today I have Boris Bosic, President and CEO of Merrick's Financial, Paul Graywall, President of Street Capital Financial, and Gino Thierry, VP of Broker Origination Sales at the MCAP Group of Companies. Thank you, gentlemen, for joining me today.
Thanks for having us.
So, I assume a lot of people do know, but for those that may not, Paul, would you mind letting everyone know what is a monoline?
Sure, absolutely. There's different descriptions of a monoline lender, but in our opinion, a monoline lender is someone who's offering mortgage products exclusively through the broker channel. Where you've got other institutions such as retail banks who have multiple channels and multiple product lines, a monoline lender is really somebody who's focused on broker channel for their sales force and their origination, is typically only providing one product, which is the residential mortgage product, to that mortgage broker for sale and distribution.
So really they're supporting the broker channel.
Absolutely. I think, you know, and we've all got our opinions, and it's likely the same. The reason, in our opinion, why monoline lenders matter is we provide competition. Without competition, I don't think brokers would be able to access the products and rates and mortgage solutions for their customers. I think that's one of the benefits of having monoline lenders. I think the other benefit is we are 100% dependent on mortgage brokers. We do not have our own sales force. We don't have a branch network competing against mortgage brokers. So our success is really based on the success of mortgage brokers in Canada. When your market share grows, our market share grows. We are true business partners of all mortgage brokers within Canada.
Well, I think this is a fair point. We probably should get everyone's opinion on it. Boris, what do you think?
In terms of my definition of monoline lender, it's a single product focus. So here's the difference, I believe, for the three of us versus the bank. Mortgages for us are not just an anchor product. Mortgages are not an excuse to franchise the customer. That's what we do. We provide mortgages. And so we're not distracted by offering a multitude of other products. And we're not looking to cannibalize the application and to get as many tentacles as we can into that customer. So we solely focus on one product, and it's the mortgage product, and its distribution is through mortgage brokers. Now, in terms, to me, why monolines matter, for Paul and I, who've been around for a few years, and our friend here from MCAP, who's still a rookie to this, but he's catching on as well. The reason that we matter is, if I look at the history of this industry, all the innovation comes from monoline lenders. Compensation, product development, service levels. It doesn't matter what it is. If it's new, it's going to come from a monoline. Now, the big banks will wait, then they'll adopt, and then they'll attempt to take ownership. But if you think and look back historically, from even look at status programs that we have, loyalty rewards programs, I mean, even Merrick's Financial, I'm not trying to plug, but I mean, from the trailer fee standpoint to your programs now, Paul, that you've implemented, this all comes from monolines. So this is why I think monolines matter to mortgage brokers. Your pay structure, your product development, and innovation, it's going to come from monolines first.
If I build on that a little bit, again, it's a single focus, as both you gentlemen have said. No bricks and mortar. We're all about the broker channel. That's who we are. That's how we make our livelihood. So we depend on the brokers to be successful. I think the other thing, though, to keep in mind is, by having monolines in there, Paul talked about competition, but it's now giving you guys choice. I mean, what a competitive advantage you have when you're looking and you're speaking to a borrower. You can come up with 3, 4, 5 different solutions and present those strategies to your customer. You don't get that at a bank, but you do get it when you have monolines in the marketplace.
Well, it's interesting to hear all three of you have similar but different messages, but also the Australians that we just had on, they were rallying behind how do they support their monoline lenders, and they call them their tier 2 lenders, but they really want to make sure that there's that honest competition, that innovation in their marketplace, and it's good to see that that's what we're doing here. Now, I guess the question is the broker market share has stalled a little bit. We're sitting at about 25% been as high as 27, close to 30%. I believe at one point we cracked just over. The Australian marketplace sits at 42. What, as an industry together, brokers, monolines together, what do we do to get that moving the other way?
Well, from my perspective, I think this is one of the biggest challenges that we face as an industry. How do we grow? And I think this problem is something that we're all going to have to address. And one of the fundamental core principles, I believe, is that broker owners, and I'm not saying this because we're on TMG, sponsored by TMG or anything, but I believe broker owners have to have the ability to make money and to make a good return on their investment and their risk, right, for the many years that they've been in business. And I only say that because they have to be the ones to reinvest back into their business so they can go out and cultivate that new mortgage broker. And I think we as an industry, and I know at CAAMP we're doing this as well, is how do we get that message about mortgage brokering, lending, or becoming an insurer to that segment of the population that may never have thought of that as a career. So I think it's a two-pronged approach. We've done a tremendous job to getting it to 25%. The real challenge now will be to get it up to 35 to 40 to 45%, but it's going to take fundamental change, and we need to rethink our strategy, how we're going to evolve as an industry.
So I think, just building on what Boris just said, the reinvestment is key. You got to take some of those earnings and put them back into the business. We have changing demographics when it comes to the population itself. You need to target market effectively. You've got to go out there and look for the business and find different ways to get the business. It's not solely going to come just through referral basis anymore, in my opinion, my own personal opinion. You want to tap those as much as you can, but maybe we've exhausted them. And, look at the real estate market. It is challenged right now. I don't know how many referrals brokers are really going to pick up in that arena anymore. It is about marketing. I have a marketing background. 8 years I spent leading a marketing group. If you can go out there, start to segment your customer base, start to look at, the demographics. Your 25 to 35-year-olds buy differently than your baby boomers, than the people that are 45 to 55, who are maybe more astute. They've already done a few mortgages in their lives. They come to a broker. But how do we get those younger generation customers in the door? So brokers do need to reinvent themselves. They've got to think about throwing some money back at that. We need to help them as Monolines. We'll provide some assistance. That's why we have some programs to aid them. But you need to be thinking about that, in my opinion.
I'm just going to add my perspective as well, just actually building on what you two have stated. The key is mortgage brokers don't effectively work their databases. We're going to hear that most likely tomorrow when Rob Daniel from Merit stands up in front of the audience again and shows the same chart that he's shown year over year that talks about how effectively to communicate to your client post-funding. That's one of the things that banks do exceptionally well. They know how to market to their client base. Brokers don't know how to do that. They're not keeping in touch with their clients on a frequent basis in a manner that their clients want to be communicated with. And that's an invaluable source for referrals and perhaps even repeat business. So I think that's one of the things that brokers need to invest in, is how to effectively use the CRM programs and tools that they have. I think the second thing, and I'll say this because I've spent some time in British Columbia, is in BC you have more retail operations and brokerages. They're not in the second floor of an office building. Why do banks not have their office on the second floor of an office building? Why? Because they want to look like we're welcoming a client in. They want the client to feel comfortable. They need to establish trust and confidence in the community that the bank branch serves. I think mortgage brokers more and more should open up retail operations.
And interesting, you talked about your Australian panel. I had the distinct pleasure of going to their conference 6 months ago in Australia, and everybody that I talked to, I asked them that one fundamental question: how'd you reach this market share? And I couldn't get one definitive answer, but there is a commonality. The second largest firm in Australia shared with me that corporately, they invest $8 million a year in corporate advertising. $8 million. Now here's what I found very interesting. He said their individual franchises on their own will invest the equal sum of money independently. So that's $16 million in advertising by one firm. Now extrapolate that over the other firms in Australia. And so the messaging is not only, you should only think about my brand, it's like, here's what a mortgage broker does for you. That is brand impression. That is specific impression into the consumer psyche that when I think about it, in Australia, they will go to a mortgage broker as quickly as they'll go to a bank because they're viewed as being on equal footing. We still don't have that here.
So would you feel as though the weight of that falls on the broker, the brokerage, the association? Like, where do you feel, or is it everybody needs to participate, and do we need someone to push that participation?
Well, we tried that as a trial balloon. We've talked about that in the industry. If you're asking me, whose responsibility it is, I think it's the business's responsibility. So if I own a brokerage firm, I have every interest to highlight my own brand and what I do, because not only does it get the consumer in through my front door, it's also a way for me to recruit and to bring in people. And not just the people that are within the industry, it's those that, might be thinking of a career change to come over. So the solution, I think, involves many stakeholders within the industry, but I think it has to come from those who will benefit the most. And I would suggest that that's the individual brokerage firms and the brokers and the agents that work within those firms.
I'll go back to a point I made earlier, which was reinvestment. So maybe to answer the question, similar to what Boris is saying, I think the onus sits with the owners, the agents themselves. Our business, the brokerage channel, I believe originates, let's say, $65 to $75 billion. Is that fair, Joe? You shave 1 basis point of that off, and I know this was the attempt. There was discussion last year, I think it was, as not long ago, last year. You take 1 basis point of that, that's about $7.5 million. You could do a lot with $7.5 million. It doesn't have to all be in print media. You've got different forms these days, the internet and such. Getting the message out. I don't think it's any one person's responsibility, but we can all help each other get there. But it's about getting the money back into the business, into the market.
Well, there's things individual brokers can do as well. It's, there's local area marketing. Get involved within your community, whether it's at a charitable level or, let's say, with sports teams and things of that nature. I don't think brokers have integrated themselves as well as they could within the communities that they serve. And that's a great way to establish trust as well as network and build relationships. So I think, it's absolutely true that the responsibility rests with the mortgage broker. I think Monolines can provide support, but I think in terms of financial support, it really needs to come from the mortgage broker, just not from monoline lenders.
We know the banks that are strong within our industry. If you think about how much they advertise and the dollars that they spend, do they spend $1 saying, use a mortgage broker? Not $1 is spent on that. But what they do is they advertise their own brand and they'll use the mortgage broker as a distribution channel. But they're advertising their own brand. To me, it's no different than brokerage firms. You're going to advertise your own brand. We don't deal direct to consumer. So for us to go out and advertise this, I don't want to find a way to bypass a mortgage broker. Our whole thing is doing business with mortgage brokers. Now, if we had to all change our strategy, well, then we would have to look at advertising if we weren't getting the support levels that we need to be able to survive from mortgage brokers, because none of us are going away. We're going to find a way to make our businesses successful. So when I take a look and I look at the major banks and how they advertise and where do they allocate their dollar and what is the messaging, I would suggest to you that it's no different than for what mortgage brokers have to do individually.
Well, and you kind of lead to an interesting point. Do you have concerns about the viability of the industry? I mean, I don't mean necessarily specific monolines, but as an industry, as brokers as a whole, does that ever sort of come into play for you that there could be concerns going forward?
In terms of mortgage brokers?
In terms of mortgage brokers.
I think brokers are at a size and scale that they're not going to go away. There's enough lenders entering into the marketplace as well as existing players that will support mortgage brokers. I think my concern is back to what we started with. Brokers just aren't investing in themselves. The one thing, and I'll go back to branch retail distribution, they're terrible salespeople at the branch level, but they get training. They have database management capability that makes them effective at what they do, on top of the advertising that we spoke about. And I think that's really where brokers need to focus their attention in terms of the future. The second thing, and I'll say this because I've dealt with mortgage brokers, I've had friends who've dealt with mortgage brokers, and I've got colleagues and friends who haven't dealt with mortgage brokers. I think that whole impression of a mortgage broker and whether or not they're professional, there's a gap there. And we haven't closed that gap effectively as an industry. and there's still a lack of trust amongst the consumer about what a mortgage broker does, and more importantly, why would I go to a broker when I can go to my own bank where I do have trust?
That's funny how Paul speaks to that, and of course you made the comment, I'm new to the business 2.5 years in and such, right? But before I came into the business, if you ask me what my impression of a mortgage broker was, I will tell you what it was. I only go there if I have bad debt. I don't know if I can trust them. Who are they? I had no idea what a mortgage broker really stood for. Getting into the business, then actually surveying my immediate neighborhood, the neighborhood that I moved in, it was amazing. It was like 1 out of 5 maybe went to a broker. It was amazing to see how Canadians lack awareness, truly what a broker is. They know brokers exist, but they don't understand what brokers are doing and how they're doing it. So branding yourself, getting the message out, that's key. Is the market going away? No. Is there opportunity for those that want to stick with it? For certain. There's a huge market. We have, what, $1.4 trillion in outstanding mortgage credit in the Canadian economy? There's a lot of potential for everybody out there.
By the way, when I said you've only been in the business for 2.5 years, that wasn't disparaging, Lynn.
No.
Like, you're a quick study, too quickly as far as I'm concerned. But in terms of the viability of this channel, the genie's out of the bottle. Right? So you're not going to get rid of mortgage brokers. And it's interesting, as much as we talk about banks, if I look at the history of mortgage brokers, what took them from 9% market share to 25, 27%? What was the banks? As soon as they lend their brand to mortgage brokers, you were no longer viewed as a lender or a choice of last resort. Because how can that be if the big banks are doing business with you? So the banks actually did a huge favor for the mortgage broker channel by lending their brands to them directly, right? However, now we've reached a stage where greater sophistication and maturation is required. So we got that credibility, we're not going away, but how do we take it from 25 to 35 and 45? Therein lies my concerns. And I think, you know, where's that sophistication going to come from? And we need it on all fronts. We need it from the monolines. I mean, we're challenged. We've got to produce products. We got to be sharper. We got to be efficient. You know, productivity issues are important. But, you know, the same holds true for the actual proprietors, the mortgage broker, and their agents. So that's my only concern is what is that next step and that next level to take us from 25 to 35 to 45?
Interesting. And I'm going to segue a little bit from that, but some of the challenges of us moving that with, and by no means it's bank bashing, but it's that the banks have been aggressive and now they've come back and we've now been regulated more. There's been government changes, so that does play in. But I guess the question is, how do the ministry changes really play into your business, and how have things been for the last 6 months? I mean, is it challenging? Is it business as usual, as a lot of people like to say, but you know, how has it been going through those changes and also the OSFI B20 rules?
Well, our funding sources come from institutions that are regulated by OSFI, so we have to be B20 compliant. From our perspective, I don't believe that the last round of changes that were introduced with respect to the mortgage insurance rules were necessary. I think we're already in a balanced market. We're seeing signs that the market was cooling. We'll see how the spring market unfolds in 2013, whether or not it has a dramatic impact in slowing down the real estate market. But in our opinion, the changes, we have to adopt them because that's exactly what our institutional funding sources expect of us to be compliant with OSFI B20 and obviously with the mortgage insurance rule changes. We have no choice. Of course.
You know, the same thing applies with our business. I think we're probably all in the same boat, really. You know, our funders, our investors, they're all regulated. So we really are regulated in a way. Some of the other changes that the Department of Finance put down, we saw some changes in the business patterns for sure with those moves. Refinance, for example, I can't speak to these two gentlemen, but overall I see brokers not doing as much refinance business as they once were. Right, but it's like anything, I think. It's cyclical. It will come back as Canadians pay down their debts. Refinance will potentially open up again. Or it depends on what the values of homes are going to be in a few years down the road. But, we saw that transition in our business. So we've seen that slide, but other things have picked up. So the market's pretty healthy still.
But from a regulation standpoint, it's interesting that I have an immense amount of respect for my esteemed colleagues here on the panel, and I go to work every morning thinking I respect them a lot, but I want to kick their ass and they want to kick mine. And this is an understanding that we have with each other. Yet we're all working in an environment today where it's the regulatory headwinds that are impacting our businesses the most, right? So it's not just about me and Merrick's and MCAP, me, Merrick's and Street Capital. It's just like, what's the government going to do? And let's face it, they wanted to slow the market down, right? And only they know what that magic number is right now. So when I hear soft landing, hard landing, that's really a question today that the government is going to determine. And to suggest that they're not going to have an influence that, I think it would be naive, because they're the ones that are controlling the levers of power. And they will continue to do that until they reach that desired result. I'm just not sure yet what that desired result is.
I'm personally of the viewpoint that I think it may have been a little too drastic, but do you guys believe that they have gone too far? This is, at this point, it's just over-regulation in a market that's already cooling.
Personally, and even the CAAMP report, which we issue, we felt that the government overreached this time. Before the most recent changes, there were already signs that the market was slowing down, specifically in the two largest markets in Canada, in Vancouver and Toronto. And so we told them to exercise caution, tread very, very lightly, because this is, the government now has literally put a target on their back. So if you're looking for somebody to blame because the market softens too much, values are depressed, and let's say they go down, people are going to want to blame somebody. Well, there's an entity out there today that said, no, we're going to slow this thing down. So we asked them to exercise caution. Now, we think it's prudent on the government to look at it from a holistic value. Consumer debt, has to be looked at carefully. A long, sustainable economy and real estate market works to everybody's benefit. But I'll tell you what, it's not an exact science. And so when you're trying to predict exactly where that equilibrium is, you may overreach and overshoot, and there are consequences to that.
I think building on that a little bit, it's interesting that we're focused in solely on ourselves right now in some regards, right? How's it impacting brokers, funders, or lenders? It's all the other impacts we're going to feel throughout the economy that the housing market touches. So there's other jobs and stuff. So did they overreach? I don't know. I don't know what that point is, right? We'll feel the pain elsewhere. We're not just going to feel it in our own business. Other industries are going to be impacted. That will be the telltale for me.
And I also think that when we look at debt-to-income ratios, there's another component of debt, which is unsecured lending, which is banks providing credit card facilities, secured and unsecured lending facilities to customers. And while there's been changes to secured line of credit, there hasn't been any regulation oversight from us with respect to the amount of debt that is being lent to customers by banks on other retail products. So I think there's an imbalance, or there's been a lot of focus on mortgage business, but not enough on unsecured debt.
But there is a report that CAAMP did issue. When we take a look at the real estate industry and the contribution that this industry makes to our GDP and employment is significant, right? And so this has sort of been my mandate over the last 12 months when I was chair of this association. I think as an industry, we have to become far more political. We make a significant contribution to the Canadian economy, and our voice has to be heard, quite frankly. And so I think from an industry standpoint, from all of our benefit, we need to become far more politically engaged.
It's everybody's problem in this business, not just one associations, one lenders. Everybody needs to come together on this and lobby harder with the government.
Maybe you guys can give the viewers a little insight, but it seems as though with all the current changes that this whole idea of the CMHC ceiling has not necessarily gone away, but it's sort of taken a back seat to everything else that's happening. Do you still worry about that? Is that something that's coming forward for you in your business?
From our perspective, absolutely. We depend on portfolio insurance for conventional mortgage funding. And it's a definite concern. When portfolio insurance disappears, we're going to be challenged with conventional funding. That's the bottom line. I think the other issue and concern is that from a CMHC perspective, how serious is the the government about really privatizing CMHC because it serves a phenomenal purpose. It provides mortgage insurance to a number of Canadians who otherwise wouldn't have been able to obtain a home, but more importantly, it also provides securitization, which has enabled us through CMB and MBS to provide low-cost funding through our companies and through mortgage brokers. So there's a definite concern that we have with respect to the cap, and more importantly, what the future will hold with respect to portfolio insurance and its availability in the future for mortgage banks who really use it for liquidity. We don't use it to offload credit risk, which is what the banks have done. They used it for deliberate intent, and that disadvantaged us as monoline lenders.
They almost filled the pool on their own in a very, very short period of time.
Paul makes a very good point. When we take a look at portfolio insurance, our benefit, of course, is that we could then compete with the banks from a pricing standpoint on conventional mortgages, where the banks were using it for capital relief and offloading it off their balance sheet. So, I mean, good for them. They're going to do what's in the best interest of their business, but we're one of the casualties. And when I say we, it's not just monolines. It's the suppliers of the monolines and the customers, and that's the mortgage broker as well.
So, probably more so than anyone, you have your pulse on sort of what the Canadian consumer is doing right now, and we don't want to just be looking at sort of the challenges that we're facing, but what opportunities are going to be presenting themselves, whether it's to monolines or it is to the broker, that you're seeing with what's going on with the Canadian consumer?
Well, I think the opportunity, it's funny, what is old is new again. Right? When we take a look at the amortization, when we take a look at our product bucket and what we can lend on and what we can't lend on, that near prime stuff is going to be golden going forward. Because we keep talking about when we make these changes to the mortgage rules, it's the tail end of the credit curve. Well, we've made 4 changes. Eventually, you're no longer at the tail end. You're at the middle of the credit curve. So you have a good portion of the population out there that qualified for mortgages, that it was a good mortgage. The net result is today they're going to have to pay a much higher interest rate. Right? They're forced to pay more money. Now, I'm not sure the government has a problem with that, because I think if it discourages borrowing, they're okay with that. So I think the challenge for all of us, and that being monolines, and I think for mortgage broker, is finding that supply of money that can take care of the near prime. There's margin in it, there's good money, but more importantly, there's good product and there's good customers that would fall into that bucket. So I think that's some of the opportunities that we have going forward.
Definitely there's an opportunity there, but I think you touched on it. It's finding the funding sources that want to play in that arena. That's a lot tougher these days.
Well, and I guess, as you sort of alluded at the beginning, we'll look for the monolines to be the innovators and find that solution ideally for us, so that we have those solutions, because consumers are going to borrow at the end of the day, regardless of the price, if they have to.
Right.
So I guess, we'll wrap up, and I'll ask this question to all of you, but, maybe for everyone that's watching, just why is it crucially important that they take the time to get to know their monolines, know their policies, understand why it truly is important to do business with the monolines today and going forward for the next 12 months?
As we started the discussion with respect to what a monoline does and how they support the broker channel, I'm not going to repeat those points, but I think more importantly, when you look at it, there's still new entrants coming into this marketplace. And when they're knocking on your door, I think mortgage brokers need to provide them with an opportunity to do business. Right now, we still have an imbalance based on Davis and Henderson. We don't have a balanced market. More banks in the broker channel control 46% of broker business. Mortgage banks or non-banks, such as us, we're around 36%. It should be an equal distribution, so there's still product going to the banks that should definitely go to mortgage banks such as ourselves, so we have a balance in terms of competition. I think the second thing that is important for mortgage brokers to understand is really the role of a mortgage bank is to grow its origination capability in its portfolio. And all of us have different approaches to it. Merrick's was one of the leaders in terms of offering renewal fees. We've certainly adopted that with the changes on our loyalty program. But there's different ways to diversify your lender base. You don't actually have to put 100% of your business with one lender. We know that created problems for some brokers who dealt with one particular lender, but you need to diversify your lenders beyond just giving the bulk of your business to one lender. There are other lenders who have different product features, compensation that can enable a broker to be far more competitive in the marketplace.
So from my perspective, why do you need to get to know your monoline? We're going to make the market competitive. We're going to give you a choice for your borrowers. You're going to add more value to your borrower when they come through your door. Without monolines, what options do you have? You can't limit them. Competition is healthy. Competition is great. I respect my peers. Again, we all have different business models and how we go to market, but at the end of the day, you need to have that choice as brokers. So get to know us, understand us, support us. Because the more support you give us, the more entrants we'll have in the business as well. I don't mind when somebody enters the market and comes in as a new lender. I think that's a good thing. Seeing big ones like First Line disappear this year, that's not good for our business, right? We got to remain healthy. So support the monolines, get to know us, and you will have great choice for your clients at the end of the day.
I would say for a mortgage broker, why it's important to support a monoline, take away all the esoteric notions and the philosophical discussions and bring it down to your most common element, greed and your own self-interest. If we disappear, it's going to impact mortgage brokers. And once again, I go back to the Australian marketplace. There used to be secondary lenders, monolines in Australia. They disappeared. 4 banks own 92% of the market share in Australia. And what was the first thing that happened? Brokers took a haircut in their commission by 30%. Why? Because they can.
I can assure you that no one wants to cut their commission today, and I appreciate you guys all joining and sharing your dialogue with us on CAAMP TV, and we'll be back tomorrow, and we'll be hosting 2 more segments, and I appreciate everyone tuning in this afternoon. Thank you guys.
Thanks.
Thank you.
Thank you.
Cheers.